Hello, Jim here. I've been selling options a long time and making some great extra income on a monthly basis. And on occasion, you have some trades that really stand out. I'm going to share with you today 5 of those from last month. I'm going to talk about the trades, give you details, and also talk about the company. So stay tuned. I think you're really going to enjoy what I have for you. Okay, let's jump into the key points. Probably with every video that I make, I like to share with people what's really important to me is picking companies that I want to own and ETFs that I want to own. I look at key criteria like debt to equity. Do they have okay debt, meaning either no debt or very low debt? To give you, for instance, say they've got 2 billion in equity. I typically want them to have no more than a billion in debt. So like a 50% debt to equity ratio. I prefer it to be lower, but a lot of companies know how to use debt and they can use it in the right ways. So that's one of the main things I look at. I also look at profitability. Do they have good return on equity, good return on assets, and working capital? Are they bringing in a lot of cash? Do they have good year over year earnings? I look at all these and I kind of compare them. And then I also be sure that they are optionable stocks, meaning I can trade options on them. Pretty much all the stocks that I own in my portfolio, I trade options on, and it works out really well. Once I do own them, I can typically double the dividends by selling covered calls, meaning I take less risk and I try to, not make so much that I put the shares at jeopardy. Because in a way, when you sell covered calls, if you don't put the strike price high enough, it's very easy for them to be called away. So that's probably the most important part, is picking the right companies. I want to own these companies. There's a lot of other traders that all they care for is making the money and keeping the cash. They don't really care to own the companies. I'm not that kind of trader. I do potentially have people like that in my memberships. I don't really restrict who's in my memberships, but I have several people that primarily all they care about is earning income, and they're less investors, more options traders to make income. Now, if you want to learn more about my memberships, details will be below. I have 3 levels. I have what's called the Investor Club. You can get a week for free, and it's the least expensive. And I provide my trades through that, all my spreadsheets. I have collections with videos and other types of material that help you with learning to trade options. I don't have anything along the lines of a full-blown class, but it's something I'm looking at down the road. The next level is what I call my Traders Club, and it includes Discord. My Discord's gotten a lot more active. I'm less worried about, forcing people to trade like I do. I want to kind of have an active, interesting community that I can also learn from. And I've had a lot of people join that are like that. So I have people, like I said before, who are just in there to make income. I have very advanced traders, even more advanced than me. I have brand new traders. And what's nice is people help each other. And with the fact that it's increasing and more, I keep adding new categories. I recently added categories of how for taxes, and then also if you want to set up a business, a S Corp or C Corp or LLC for trading. I found some stuff related to that. So some discussions are occurring along those lines, looking at adding a potential text channel related to zero DTE type trades. So it's getting more and more active. So that's the second level. And then the third level is coaching. I do provide some one-on-one coaching, some hand-holding. It does include 2 15-minute sessions each month, and that's called the Coaching Club. So the Trader Club Coaching Club, there's no free version. You have to pay to get in. And the Investor Club, you can kind of try it. And again, I don't force people to have phone calls. You can join. People move, they leave, they come back, they go from, one level. They might go from Investor Club to Coaching Club, and then maybe down to Trader Club. So it's pretty dynamic. It works fairly nice, and you get access to all my trades. And actually, if you're in the Discord, you get access to other people's trades. So That being said, here's some of the key points. Each month when I complete my trades, I like to go back through them. I like to look what worked, what didn't work, what might I need to change going forward. A few things that I have picked up on, and I've talked about it in other videos, and it's one of the things I struggle with is closing the trades. The ones I'm going to share with you at the end of this video, I closed all of them, so they are complete trades. And definitely you do better if you close the trades. Rolling is just closing and opening a new position, but definitely if you close and then later open a position, you typically do better. And that's what I found. I probably close 15 to 20% of my trades. I want to get that up to more like 40 or 50%. So it's something I'm going to actively work on. Another key thing I learned is the vertical put credit spread during kind of trying times. It's better than just using a cash secured put. Having the protection on the downside has helped me lower my cost basis in some instances when a stock is dropped big time, like two recent ones were Path and Polaris both dropped majorly, even though, well, Path did miss some earnings. Polaris really hasn't missed any earnings. Also Zoom did also had a major drop in the last couple of weeks. So by having that protective put, it keeps you where you limit your losses, but then you also lower your cost basis because that put you purchased becomes worth more and more. And that's helped me in several of the trades. So I'm probably doing vertical put credit spreads more often than not right now. I do have a few cash secured puts, but probably 80% of all my put related trades are vertical put credit spreads. I also in the past have done what I call the IWM income trade, and that's the Russell 2000. I like to use it instead of SPY or QQQ. I find that a lot of times the returns are very similar and it's just easier to deal with. It's $200. I think IWM is right around $200. It might be $199 now. QQQ and SPY are $400 or $500 each. So you need a lot more assets to deal with it. So in the past, like last year, I think I did almost 15 to 20 trades just in IWM just to make cash. And I did not have any get assigned to me. I did have to roll or move some of the trades around a little bit when IWM got right around 160. But it's a trade I'm going to look at doing more. One of the trades that I'm going to share with you at the end of the video is IWM and how it's worked out well. I'm actually looking at making another IWM trade either today or tomorrow, most likely. And I did that a lot more last year, so it's something else I'm looking at. The next big lesson, and some of you who've been watching my videos for a long time probably know this, I'm going to avoid earnings. So I'm taking that extra step. It may mean less premium. I've gotten into a kick of wanting to earn more and more per trade. I was like $300-$400 per trade, which is good. But when you bridge earnings, meaning the expiration is right around earnings, you have a potential of being hit hard. And that's what's happened with CVS, with Path, and a few other companies. I think Starbucks it also happened with. So I'm typically going to try to have the option contract expire before earnings. So if earnings is July 19th, hopefully it'll be like the 16th, the week before that it expires. Now, if earnings are bad, then I might jump in after earnings because again, it seems like a lot of the companies just get hammered if they slightly miss earnings and if they give bad guidance. If they lower their guidance for the rest of the year or next year, they also get hammered a lot more than it used to be. I remember, because I've been trading since the 80s, that they'd miss earnings. They might move 5% maybe, but not 30, 40, 50% of the value of the stock. So I've learned that lesson. It's something I'm going to avoid. I'm also going to adjust my trades. At this time, with the market being so high, I'm taking less risk. I'm using a lower delta, meaning if I'm selling a put, I'm using a strike that's lower. And if I'm selling a covered call, then I'm picking a strike that's even higher, more like a 10 delta, 15 delta. Just something I'm doing at this time. It does seem like the market is kind of way overbought. Not all companies, but the market in general. There's some companies that are still beaten down. Like I said, Zoom, in my mind, is beaten down. So is Polaris. So I wanted to share that. I wanted to just kind of give you a brief overview before we jump into the trades. And as always, please hit that like button, subscribe. I'm trying to get the word out. I want people to learn that this is a great avenue to make some extra income for either becoming financially independent or having an easier retirement or being able to retire sooner. So that being said, let's jump into the last part of the video where I share with you these 5 trades. Okay, here are the trades that I made last month. These are my best trades and they were all closed. So the return on investment for these, or what I call my yearly return, is very accurate. One thing that's in common with all of these, I closed them early, so my original return on investment was lower. Since I closed them earlier, the DTE is less, so it improved the return. And you'll see that when we talk about each of these. Now, Logitech, LOGI, is another one of those companies that has no debt. It's a good performing company. They also did beat earnings and shot through the roof at one point. I put this trade on in April, so 4/15, 2 contracts. I made the trade. I closed it on 5/9/24, so early last month. And it was a vertical put credit spread with a 75/65. I believe the stock was around 82 at the time. And the delta was 0.249. Now, I forgot to write down a lot of the deltas for these. And then the return was, so I had premium of 232.90, which the required capital, which is the 2,000 minus the 232.90, comes up with 1767.10. The DTE was 24. That's after closing it early, and my yearly return for that one was 200.44, so just slightly over 200%. And again, it's this divided by this, adjusted for the year, which is 365 divided by 24. And this went from 150% return. I believe I did or talked about this in a previous video. So it went from 150 yearly return, 150% yearly return, to over 200%. So not bad at all. Next is Apple, another really good name. Little debt, probably one of the best, if not the best run company out there. I currently don't own any Apple. I've sold a lot of options on Apple over the years. At one point early last year, or 2 years ago, I think it was 2021, I kind of got into a trend of doing 2 every other week. So I would do 2 Apple trades, and then the next week I would do 2, and so on and so on. Now, it's something else I might look at too. Now, I do feel like Apple's a little bit pricey, I believe it's right around 200. But I did this trade on 4/8, 2 contracts. Closed it on 5/20. It's a vertical put credit spread, 165, 155. At the time, it was 183. I believe all of these trades were right around a 15, 18 delta. So it was still almost $18 cheaper than the current price of Apple. And I brought in 357. Apple's one of the big boys, so it has really good premium. So the required capital, which is 2,000 minus 357.28. 42 days DTE, so I had it open for 42 days, and it was like almost 190% return. And this one went from a 114% return to a 189. So again, closing early made a big difference. IWN, this is the trade I'd like to make just to make cash. I trade this like other people trade SPY or QQQ. It doesn't mean I might not trade those down the road, but I haven't recently. I primarily do IWM. I did this on 4/16. I closed it on 4/28. So only 12 days later, it was a vertical put credit spread, 180, 170. The original expiration for it was 6/21. At the time, it was 208, so it was pretty pricey. So again, I'd For these IWM trades, if it's a vertical put credit spread, I try to do the short is like a 15 delta. And that's why it was only 180, 170. And then I brought in 215. So I did bring in a little bit less compared to somebody like Apple, but still it was a good trade. 42 days DTE, cost of capital 1784, 104% return, almost 105. And it went from a 73% return before closing to around 105% return. So again, definitely did better. Now this is one of the other companies that I like, Pure Storage. Another growth company, technical based. I believe it's a mid cap. I'm not quite sure how big it is. Did this trade on April 9, 2 contracts, closed it on 5/28, so only had it open, 3 weeks? Something along those lines, 19 days, so not quite 3 weeks. Vertical put credit spread 45, 37, 50. Again, expiring on 6/21. It was 59 at the time, so the short was 45, so pretty far outside the money, fairly safe, and it actually has gone up higher. I think it may be over 70 now. Brought in 221, since it was a thinner spread, so 37.45 was $8 spread, so the value of the spreads is 1,600 minus the 221. That's how I came up with the 1378. One thing I do like to share with my members is I typically will start with a $10 spread, then I'll back it up one. I'll do a $9 spread, see if that's, if buying that put is cheaper, and then I'll try again and again. And I would say maybe 30-40% of the time I'm able to back it up to like an $8 spread, and I earn more premium on that $8 spread than a $10 spread. So something to keep in mind when you're making these trades. This had a 49 DTE, 120% return, so it went from 87% to 120 with closing early. Last but not least, this is the AppLovin company. They, I believe, work directly with Apple. I think they have an area where they make apps for both Apple and different environments. So I made this trade on 4/15, again, 2 contracts. I like to do 2 contracts. I may do more down the road, but it's just, I went from 1 to 2, and I may go from 2 to 3 or something along those lines. It's one of those slow and steady transitions I like to do. I don't like to, jump off the high diving board. I like to, maybe go to the mid-level diving board before ever getting near that diving board. I closed this on 5/10. It was expiration 6/21, so quite a bit early. 57.50, 47.50 for the strike, so a $10 spread. Brought in 296. The required capital was 1704, and the DTEs were 25. So I had like a 253% return. One of the best returns I've ever had. Just a good overall company too. And this went from 105% return to over a 253% return. So the average DTEs when I closed them early, it was 36 days, almost 36 and a half. The average ROI, or yearly ROI, that is right around 173 and 0.49, which is definitely better than if I just let them expire or if I end up having to roll them. So, and there's times being that I'm still working, I might get busy with something else and I might have the opportunity to close it, but I don't notice till the next day, or I miss the opportunity. So let's look at the notes. Better to close than to open a new position, and then open a new position. So, and again, that's just rolling. Rolling is closing and opening a new position, and you hope to bring in enough cash to cover the cost of closing the existing position. IWM, just for income, I've never had it assigned. when I do it is an iron condor with 10 strikes on either side. I usually will go a little bit farther out on the call side because I feel like that's a little bit riskier. I've never even had to adjust the iron condors for those trades, so I'm probably going to do more of those. And then all had better ROI with closing early. So that's what I wanted to share with you guys. I'm going to share all my trades for May in the next video, probably next Thursday. I did have 3 companies. I had Pass, CVS, and Zoom, I believe. I might have had 4 get assigned to me early, and I'm actually calculating that in as losses, even though when you calculate it, it's kind of weird because it's the value of the stock at that time. To give you, for instance, I calculated it with CVS at 57, but since then it's come up to as high as 60. So, but that'll be in the next video. And I had more trades than usual, which helped buffer some of those losses. I still did quite well for the month, but I've definitely been having a tough time. I think I removed it. You know, my goal being 8,000 a month with just premium. This month or last month I definitely missed it. I'm probably going to racket that back to, or roll that back to 7,000. I went from 6,000 to 8,000. And I found that I was pushing myself to earn too much per trade. And then, you know, learning the lesson related to, you know, having something expire right near an earnings release, it's been a big lesson. So I'm probably going to roll that back a little bit and adjust some of my trades. So, you know, not try to make so much, just stick to good quality trades. And you know, maybe with the market being so high, like I've mentioned before, I'm going to take a little bit less risk, lower those deltas in making these trades. So that's what I wanted to share with you guys. Let me know what you think. I'd be curious if you make trades like this too. You know, do you use QQQ or SPY? And what other companies might you want to share that have worked out really well for you? So thanks for joining me, and I look forward to seeing you next time.